Okay, we've completed our transaction log and we completed our chart to help us identify how we're going to increase and decrease accounts. Let's start our journal entries. So first we have our first transaction where Boog Inc. issues cash or ownership interest in exchange for $200,000. We increased cash for $200,000 and we increased stock for $200,000. So we're going to start with our debit. We're going to abbreviate as DR. We always start with the debit first, the credit comes second. The debit's on the left, the credit's on the right. And the first account we're going to impact is cash. We increased cash by $200,000. Cash is an asset account, and so to increase cash, we would debit it. So I'm going to enter my account name cash and the amount, $200,000. Then we're going to credit. I want to record the increase to stock. We increase stock, which has a natural credit balance. It's an equity account. And so to increase stock, we credit it. So stock, 200,000. The next transaction was Book buys inventory for $5,000. Okay. So we will have a debit and a credit. So first we have an increase to inventory. Inventory is an asset with a natural debit balance. So we're going to increase inventory by debiting it. So I'm going to type in inventory and record a debit of $5,000. The other side of this transaction was an increase to accounts payable of $5,000. Accounts payable is a liability with a natural credit balance, so we'll increase with a credit. There we go. Next, Book buys equipment for $72,000 cash. The equipment has a 3-year life. Okay, so we decreased cash and we increased equipment. So let's start with cash. We decreased cash by $72,000. Cash is an asset, and to decrease, we credit. So we're going to credit cash for $72,000. We increased inventory or equipment. Equipment is an asset, so to increase an asset, we debit. So we'll increase equipment for $72,000. We sold consulting services on account for $50,000. We increased accounts receivable and asset by $50,000, so we will debit it. We increased revenue. Revenue has a natural credit balance. Revenue has natural credit balance, so we increase revenue with a credit. So we're going to type in revenue, credit. All right, the next transaction is the exact same transaction with a different amount, so it will look exactly the same. But for $70,000 and a credit to revenue for $70,000. Okay. Next, we are going to pay our employees $10,000. So this is transaction 6. We decreased cash by $10,000. Cash is an asset with a natural debit balance, so we'll decrease with a credit. So cash, $10,000. The same time we increased expenses, expenses have a natural debit balance, so we're going to call this payroll expense, and we're going to debit it $10,000. Next, we're going to pay rent of $5,000. This is transaction 7, so we decreased cash for $5,000. That's going to be a credit to cash. We decreased cash with a credit. And we are going to increase expenses. We increased expenses with a debit. So we're going to call this rent expense. And we're going to debit it for $5,000. You notice each of our journal entries have to equal. Our debits always equal our credits. 5,000, 5,000, 10,000, 10,000. You want to make sure your debits always equal your credits. If they don't, you've done something wrong. You want to go back and give it another try. All right. We are moving through these. Okay. So we received $50,000 from the customer we billed in transaction number 4. This is transaction number 8. We increased cash for $50,000. So we know that cash is an asset. We increase assets with a debit, so we are going to debit cash for $50,000. We decreased accounts receivable, the promise to pay. The customer doesn't owe us money anymore, so we decrease accounts receivable. Accounts receivable is an asset, so we decrease an asset with a credit. Okay. We are going to record our depreciation expense. This is AJA number 1. All right, so we decreased, actually accumulated depreciation as a natural credit balance, and we increased it, so we want a credit, but it is an asset. And this account basically decreases the value of our equipment. So we are going to book a credit to accumulated depreciation for $2,000, and we booked an expense of $2,000 for depreciation expense. Expenses have a natural debit balance, so we will debit depreciation expense for $2,000. All right, last transaction. We paid a cash dividend equal to 10% of net income. All right, we decreased cash by $10,300. Cash is an asset. We decrease an asset with a credit, so we're going to credit cash for $10,300. Over here, we increase the dividends account. Dividends has a natural debit balance, so we increase dividends with a debit, and we will do that right here for $10,300. Again, we make sure our debits and credits equal, and they do. All right, that is the last of our journal entries. In the next video, we will look at taking these journal entries and putting them into T accounts.